Hi, my name is Ray. Welcome back to another episode of Ray's Investment Clue Book. Today we'll be building on our lessons about money market funds by talking about a peculiar case in 2008 to provide some lessons within the risks of the money market funds. So we talk about money market instruments and mainly talk about treasury bills, CDs, repos, and money market funds and federal funds rate. And most important, treasury bills, of course, are basically cornerstone for the money market instruments because they're seen as relatively risk-free. They're basically backed by the federal government. And so that plays an important role within our lesson today. So in 2008, as we all know, it was a big recession since basically the Great Depression. And so one thing that happened during this is money market funds had a huge dent in its market. And now one factor you need to realize is the money market funds that are not provided by banking products such as checking accounts that incorporate money market funds through mutual funds or just privately traded are not FDIC insured, so they're not really backed up by anything. And so they can blow up, per se, due to the mutual funds that provide them investing in risky assets that can provide huge losses. So for context, during 2008, of course, we all know the housing bubble burst and the housing market was in a massive hole. And on September 7, 2008, Fannie Mae and Freddie Mac, two corporations within the housing market, basically had the U.S. government step in and conserve them. And so a week later, or 8 days later, on September 15th, Lehman Brothers filed bankruptcy, which had a large ripple effects throughout the rest of the market, the rest of the economy, basically. Because a day later, reserve money market funds, their $62 billion worth of money market funds by the mutual fund reserve basically broke the buck. Their net asset value decreased below $1. And so that broke the confidence within them because basically these investors' money just lost value. And a reason for the loss in confidence was because their almost $1 billion, around $750 million invested by reserve in Lehman Brothers basically just vanished in midair because Lehman Brothers now does not exist. And so as a result, of this nearly $1 billion investment just disappearing, nearly $60 billion of the money market funds from reserve were requested to be withdrawn, and a huge flight was sent into the government money market funds, which were seen as more risk-free. And so basically that's all of the money market funds almost were withdrawn, and this all happened basically within the span of 9 days. And so basically 3 days later, all these events are happening within less than 2 weeks. And so this just goes to show how rapid of a recession, how rapid of an effect all of these individual, seemingly isolated events had on the money market, relatively risk-free money market. And so the commercial paper basically got frozen due to Lehman Brothers collapsing. And Lehman Brothers collapsing, basically investors had no confidence in commercial paper or short-term commercial bonds. And so this really affected many industries, many corporations, especially banking corporations that required or that had to rely on commercial paper for day-to-day operations. And so on September 19th, 2008, the U.S. government had to step in and guarantee insurance or guarantee backing up money market funds, which were followed up by other facilities in September and October 2008 later on. And so although this did increase confidence in the money market funds, it did somewhat stem the flow into treasury bills that all investors were flying towards as a risk-free option. There was still a large flight towards treasury bills. It did not completely stop it by any means. And so, as a result, the U.S. successfully became temporary buyers of commercial paper in true Keynesian fashion. They had to step in and basically revive the market before it collapsed. And as a result, it basically implicitly guaranteed about $1 trillion of funds in the commercial paper market. However, at the end of the day, it was successful in retaining the market in true Keynesian strategy. So, following this, of course, there need to be reforms because we can't see the money market fall into a hole like this. It's supposed to be a more stable, relatively less riskier option. So we can't see it almost collapse like this. So the SEC procedural reforms following the recession in 2010 basically required the weighted average maturity to go from 90 days to 60 days. So lesser maturity means more liquidity, basically. And of course, there was also more liquidity buffers because these investments had to be at least 10% of these had to be cash or super liquid cash, super liquid options that are basically cash within 1 day. And so this, of course, played into their overall strategy of increasing liquidity, which subsequently decreases risk within the money market. Of course, there are also more restrictions on second credit tier securities, basically securities that were not rated AAA, because lower securities, even AA or A, or of course even lower than that, and then junk securities, of course they're a lot more riskier and basically cancel out any benefits of liquidity. And so eventually in 2014 we reverted back to a floating NAV, basically meaning that since 2014 we are now returning to the risk that the NAV or net asset value can break the buck and fall below $1. So I guess there's more freedom in the market and also more risk. However, none of these reforms apply to government money market funds, because government money market funds, as we were basically talked about, or treasury bills, they were basically seen as a risk-free option, even in such a dire condition in 2008. So for our final clues, basically government money market funds are basically considered virtually risk-free. Now, of course, you can't consider them 100% risk-free, but they're backed by the federal government, so you can probably place most of your trust in government money market funds or treasury bills. Of course, there are also other institutional money market funds that are also relatively less risky, but they still bear a higher risk of breaking bucks and breaking your bank in the end. So thank you, and see you next time.